Hello and welcome back to our second demo video dealing with Chapter 6. Chapter 6 we talked about variable costing and segment reporting, and in this video I want to start off with exercise 6-3. Now before we jump into this, I want you to do me a huge favor. If you look at your study guide, it's probably different than mine, because as I created it I started punching in some numbers and recognized that I made a mistake. So what I want you to do in your fixed MOH in ending inventory, I want you to go into that box. I want you to right click and I want you to put insert row above. And once you do that, you should have a blank row right here. Mine says changes in inventory. Type in changes in inventory and then we'll talk about the rest of this. Okay? So we have to recognize that inventory, or I should say the levels of inventory or the changes of levels in inventory, actually have an impact on the net operating income when we're looking at it from the absorption perspective or the variable perspective. Okay, so let's think about it this way. If there's no changes in inventory, right, we start with 0, we end with 0. That means that the units that we produced equal the units that we sold. No change in inventory. In that example, the net operating income under absorption costing and under variable costing are equal. Okay? But if inventories change, meaning if they increase or decrease, that's going to have an impact on the net operating income from the variable perspective or from the absorption perspective. So let's think about it this way. If our inventories are going up, meaning beginning inventory is 100 and ending inventory is 120, okay, so our inventories are going up. Absorption costing, or let me rephrase that, net operating income is going to be higher under the absorption costing method, and it's going to be lower under the variable costing method. Okay, that makes sense. As inventories go up, we know that cost on the absorption method hangs out on the balance sheet until it's sold. Because we're increasing our inventory, that cost is not recognized as a sale. It sits out on the balance sheet. Under the absorption costing, we recognize that higher fixed manufacturing overhead as soon as it incurs. So that's why variable costing is going to be lower as inventories increase. Now, as inventories decrease, what happens? Well, as inventories decrease, absorption or net operating income under the absorption method is lower than net operating income under the variable perspective. Okay, so we have years 1, 2, and 3. We're going to calculate the changes, right? So let's think about it this way. In year 1, we started off with 200 units in beginning inventory. The end of the period, we have 170 units in inventory. So what happens? Our inventories are decreasing. So we're 30 units, inventory is changing, it's going down. Because inventory is going down, we would expect the absorption costing net operating income to be less than the variable costing income. Okay, so let's look at year 2. What's happening in year 2? Well, we started with 170, we ended with 180. So guess what? Our inventories are increasing. We increased it by 10 units. So if inventories are going up, we would expect absorption costing net operating income to be higher than variable costing net income. Let's look at year 3. What's going on in year 3? Start off with 180, ended with 220. Okay, our inventory is going up. It's going up by 40 units. because our inventory is increasing, we would expect our absorption costing net operating income to be greater than our variable costing net income. Okay? So we need to show, or first of all, we need to calculate absorption costing net operating income based on what our variable costing is and what our change in inventory is. Okay, I'll show you how to do that. It's super easy. Let's look at year one. Year one says we're going to calculate the fixed manufacturing overhead in ending inventory. Okay, well, we ended with 170 units times our fixed MOH, which is $560. That ends up being $95,200. Okay, now let's look at the fixed MOH in the beginning of the period. Okay, well, 200 units times, again, the fixed manufacturing overhead per unit, which is $560. Our beginning fixed MOH, if you will, is $112,000. Okay, we're going to take the difference. Now let's think about this. What's happening here, right? Our inventories are decreasing. So as our inventories decrease, that means that fixed manufacturing overhead is going to be released from inventory. Okay, it's going to be released from inventory. There's going to be more expense. Because there's going to be more of an expense, there's going to be, or should be, less income. Okay, so what's the difference between these? Well, 95,200 minus 112,000 is $16,800, right? Negative. Okay, so that means we're releasing fixed manufacturing overhead from the balance sheet to the income statement. Okay, so we now need to deduct the fixed MOH cost that's released from inventory under the absorption method. Okay, so we're going to subtract out our $16,800, and we end up with the absorption costing NOI of $1,063,600. That makes sense. Why? Because our inventories are decreasing. Because our inventories are going down, we're releasing from the balance sheet to the income statement. Our expenses are going up. Because our expenses are increasing, that means we're going to have a lower net operating income. Okay? Makes sense. Now, let's look at year two. Year two, our inventory is increasing. We know when our inventory increases, absorption costing net operating income is higher than the variable costing net operating income. This makes sense. Why does it make sense? There's more inventory or more fixed manufacturing overhead sitting on my balance sheet, not on my income statement. Okay? Under the absorption method, because that fixed MOH is still on the balance sheet, my expenses are going to be lower, which will drive up my net operating income. Okay? Let's see how it looks mathematically. So first thing we want to do is take the fixed MOH in ending inventory. Ending inventory, we have 180 units times $560. We get $1,800. Okay? What is the fixed MOH in beginning inventory? Well, we take 170 times the 560. We end up with $95,200. The difference between those two is a positive $5,600. Okay, that makes sense. Why? Our ending inventory is going up. That means there's basically $5,600 of fixed manufacturing overhead sitting on the balance sheet. It's going to stay there until we sell those units, then it goes to the net income. Okay? So, because fixed manufacturing is deferred to inventory, what does that do? It drives up our net operating income under the absorption method. So, we're going to add to our variable net operating income, we're going to add the fixed manufacturing overhead cost that is deferred in inventory under the absorption method. So we're going to add $5,600. Oh, $5,600, sorry about that. That means that our net income is $1,038,000. Oh, sorry. $1,038,000. That makes sense. Why? Inventory increases, absorption costing net operating income is higher than the variable costing. Again, that makes sense. Why does it make sense? Because we have more in ending inventory. Okay? Under the variable method, we take that higher fixed MOH and we recognize it as a period cost. We recognize it as soon as it incurs. Okay? Let's look at year 3. So year 3, start off with 180 units in ending inventory. Okay? So if we take our fixed MOH and ending inventory, we take 220 units times the $560 fixed MOH, we get 123,200. Now we calculate the fixed MOH and beginning inventory. So we take the 180 units times the 560. We end up with $100,800. When we subtract these two, we see that, hey, we have 22,400. Okay, that's the difference between the two. So what's happening here is fixed manufacturing overhead under the absorption method is actually deferred to inventory. Okay, so because inventories are increasing, absorption costing net operating income has to be greater than variable costing net operating income. That makes sense. Again, why does it make sense? Because variable costing is recognizing all of the fixed manufacturing overhead. Okay, all of it. The absorption costing is only recognizing the fixed manufacturing overhead that's sold. Because there's still 40 units sitting on the balance sheet, that's expense that's not going to flow to the income statement because it remains on the balance sheet, which drives our expenses down, which increases income. Okay? So, I'm going to add the fixed manufacturing overhead costs that was deferred to inventory under the absorption method. So I'm going to add this 22,400. And I end up with $1,018,800. Okay? Now, if you notice, I did not put 2A and 2B on your balance or on your income, or on your study guide. That's okay. We're going to talk through it. Okay? So basically what's going on here is that, They say that assume in year 4 the company's variable costing net operating income. I'm just going to come down here and type just for kind of notes, okay? Variable NOI is 984 400, and absorption costing NOI is $1,012,400. Okay. They want to know, did inventories increase or decrease in year 4? How much fixed MOH cost was either deferred to or released from inventory during year 4? Okay. Well, this is easy peasy. We can do this, right? Because we know this stuff. We know that if absorption costing is greater than variable costing, inventories have to be increasing. So I'm going to say because, usually helps if you can spell, sorry. Because absorption NOI is higher than variable NOI, then by default inventories have to be going up. Are increasing. Okay, have to. Now the second part of that says, or wants to know, how much fixed manufacturing overhead cost was deferred or released from inventory during year 4. Well, if we know that absorption costing is greater than variable costing, inventories go up. So in order for us to figure out the difference between those two, what we can do is we can subtract, right? We can subtract our net operating income from the two that we have here, the 984,400 and the 1,012,400. We can subtract those two and recognize that, hey, there's $28,000 difference. That amount of $28,000 is what is deferred to inventory. Okay, so that's exercise 6-3. Okay, so the next thing we have, or the next exercise we have, is exercise 6-4. Now 6-4 goes from page 287 to page 288. Okay, and basically what they want us to do is they want us to create a segmented income statement. Okay, we have Royal Lawn Care Company. They sell two packages, the Weed Ban and the Green Grow, right? They give us information about revenue and variable cost for each of these. They also tell us what our traceable fixed costs are, and they also tell us what our common fixed costs were. They also tell us what the company produced and sold for each of these. Okay, so I'm going to scroll down here. Now, this is the contribution formatted income statement. Sorry guys, it's getting late. Okay, so not too much different than what we've seen before, right? We have our sales less our variable cost gives us our contribution margin. From our contribution margin, we know we subtract out fixed costs, right? Well, when we're dealing with a segmented income statement, we have two types of fixed costs. We have traceable fixed costs and we have common fixed costs. The difference between the two is pretty easy, right? Traceable fixed costs means that we can trace them to a specific product line, segment, whatever, right? Traceable fixed costs say if we get rid of a unit, guess what? Those fixed costs, those are specific to that unit or that product line or that division or that segment or whatever. If we get rid of that, those traceable fixed costs go away. Common fixed costs, well, they're common to both segments, right? If we get rid of one segment, the common fixed costs are still there, meaning we can't trace them to a specific segment or division or product line or whatever, right? They're common, they're gonna remain, okay? So what we need to do is go ahead and calculate our or prepare our segmented income statement. So notice what we have here. We have a total for the company, we have weed ban, and we have green grow, okay? So we know that they tell us that green ban, we sell 15,000 units, and for green grow we sell 28,000 units. Sorry about that. We sell 28,000 units. Okay? And we know what the sales price is for green ban and for green grow. Green ban, the selling price is $6. For green grow, the selling price is $7.50. Oh, $7.50. Okay. So we need to figure out what our sales are for green ban or weed ban, green grow, and then the total company. So the sales for green grow, $7.50 per unit, $7.50 per unit times 28,000 units. That gives me sales of $210,000. Okay, it's pretty easy. For weed ban, do the same thing. What are the number of units we sell for weed ban? 15,000 units times the unit selling price of $6. We end up with $90,000. So what's our total sales? Well, the total company sales, we need to include both green grow and weed ban. So we're going to add up basically the 210,000 plus the 90,000, and we end up with $300,000. Okay. Now the variable costs. The book tells us, or they give us, what the variable costs are for weed ban and green grow. I'm going to put them down here just so we know. We know for green grow it's $5.25. We know for weed ban that the unit variable cost is $2.40. Okay, we can calculate the variable cost for weed ban and for green grow. Let's do green grow first. So if we take $5.25 times 28,000 units, we get a variable cost of $147,000. We're going to do the same thing for green ban, or weed ban, excuse me. $2.40 of variable cost times 15,000 units gives us a variable cost of $36,000. Well, what's the company total variable cost? Well, it's just the summation of weed ban and green grow's variable cost. 147,000 plus 36,000 should give me $183,000. So we now calculate the contribution margin, right? Or the segment contribution margin. That's easy for us to do. We know how to do that. Sales less variable costs. So the contribution margin for green grow, 210 minus 147 gives us $63,000. Same thing for weed ban. What's the contribution margin? Well, 90,000 minus 36,000 gives us $54,000. So what then is the company total contribution margin? Guess what? We can do one of two things. Take 300,000 minus $183,000. That's the company contribution margin. Or we could add up Green Grow's contribution margin of 63,000 plus weed ban contribution margin of 54,000. We end up with $117,000 total company-wide contribution margin. Okay, so the company tells us, or the book tells us rather, excuse me, that, oh, by the way, traceable fixed costs to Green Grow, it's $21,000. Okay, $21,000. So there's fixed costs of $21,000 that Green Grow and only Green Grow incur. For weed ban, that's $45,000. $45,000 fixed costs, right? Again, those are traceable fixed costs. Those are fixed costs only consumed by weed or incurred by weed ban. If we get rid of weed ban, guess what? Those $45,000 of traceable fixed costs go away. So what then is our total traceable fixed costs? Well, that's easy. Just add them up, right? 21,000 plus 45,000 hopefully gives us $66,000. Okay, so now we can calculate the product line segment margin. The product line segment margin is the margin or the amount that each division, each segment, each territory, whatever, each product line, it's the amount of contribution margin or segment contribution that they contribute to the common fixed cost. Okay, since we can't trace them specifically to either one of these segments, they're fixed costs that we still have, common fixed costs. Think of things like maybe, I don't know, the building, right? Maybe we have a huge building and one side we make weed ban, and the other side we make Green Grow. Well, we have costs associated with that building, right? If we get rid of Green Grow, well, we're still going to have the building and we're still going to be making weed ban, right? Same thing with CEO salary, right? He's a he or she's the CEO. They got to run the company, right? If we get rid of a segment or a product line or a division, well, that CEO is still going to be there running whatever's left. Okay, so to figure out what the product line segment margin is, we take the contribution margin, subtract out the traceable fixed cost. We end up with $42,000 of product line segment margin for Green Grow. For weed ban, we end up with $9,000. That means we have a total product line segment margin of $51,000. Now we factor in our fixed costs. Well, they tell us that the the common fixed costs that we cannot trace are $33,000. So from the company total, we're going to subtract out our $33,000, and we're going to come up with the company-wide net operating income, which is $18,000. Okay. Now, what if we say, you know what? Let's get rid of Green Grow. I don't know why we want to, but let's just say we decide to get rid of Green Grow because it has a higher variable cost, right? Well, if we get rid of Green Grow, guess what we're getting rid of? We're getting rid of $42,000 of product line segment margin to contribute to the common fixed costs. Okay, so the point is, when we're analyzing this and we're thinking, well, should we get rid of one division or one product line or one territory, we need to consider what are we getting rid of, right? What are we losing? Well, we're losing this product line segment margin, okay? So if we get rid of weed ban, well, we'd be okay, right? Because we'd have $42,000 of the green grow product line segment margin to cover those common fixed costs, right? So just keep that in mind. Okay, last one, we got complete exercise 5-62. And you might be looking and saying, that dude didn't give me a anything to write in. Well, we don't really need a template here because what we're going to be doing is calculating company-wide break-even points as well as region break-even points. Okay, so before we do that, what we're going to do is we're going to write down the first thing we need to know, which is very important, the calculation, right? How do we calculate the break-even points? Well, if we're looking for the company, let's just say COMP, and we'll do dollar sales because that's what they're asking for. Bear with me here. Okay, so to calculate dollar sales for company to break even, sorry guys, this new mouse is killing me. Okay, what do? Well, it's pretty simple. We are going to first calculate what our traceable fixed costs are. I want a single underline. There we go. Traceable fixed cost plus we're going to add our common fixed cost and we're going to divide by the overall CM ratio. Okay, that's pretty easy. We can do that. So let's figure out what is our traceable fixed cost. Well, they're $120,000. They're $120,000 are traceable. What are our common fixed costs? Well, they're $50,000. Okay, not a problem. We can do that. That's easy, right? Sorry guys, I'm a little anal. I want to put in that division line. Okay, so now we got to figure out, well, what's our contribution margin? Well, they really don't tell us, right? They don't give us what our contribution margin ratio is. We need to calculate that. Well, that's easy for us to calculate. We're looking at the company-wide overall. We know the contribution margin is $240,000. We know if we divide that by our sales, that'll give us our contribution margin. Okay. Put in my brackets just to make it look neater. Okay, so we end up then with $170,000 divided by 0.4 or 40%. That gives us $425,000. That's the sales dollars for the company to break even in total. Okay, so the next question they ask us, number 2, says, okay, let's go ahead and let's calculate, this is part 2 actually, let's or number 2, let's calculate the break even in sales dollars for the northern region. Well, that's easy. First thing I got to know is, what is the calculation for the segment? Well, to calculate that, to calculate the sales dollar for a segment to break even, I need to take the segment traceable fixed cost or fixed expenses, and I need to divide that by the segment CM ratio. Okay? All right, I can do that. That's no problem. What is my segment traceable fixed cost for the northern region? Well, traceable fixed costs are $60,000. I then need to divide that by the CM ratio. Well, they don't give me the CM ratio, but I do know that the contribution margin for the north region is $120,000 divided by the sales, which is $400,000. I then end up with $60,000 divided by 0.3, or 30%. The break even in sales dollars just for the north region is $200,000. Okay, and then you do the same thing for the south region. I'm not going to go through that. I think it'd be kind of a little bit redundant, but you're using the same calculation, right? Segment traceable fixed costs divided by the segment CM ratio. Okay, so those are all of your questions, right? We did 6.1, we did 6.2, we did 6.3, we did 6.4, and we did 6.5. So you are good to go. Just make sure you do the south region break even point in sales dollars for your study guide. Okay, if you guys have any questions, please feel free to text me. Totally not a problem. I'd be more than happy to discuss any questions you have about the material or the videos or anything like that. Okay, so thanks for tuning in, and don't forget your chapter 5 exam is due at the end of the week here. So if you haven't done that, make sure you get on that. Good luck. There is a review video for you to review quickly. You know, kind of like what's on the exam, as well as utilize your pre-built Connect. Okay, so thanks for tuning in, and have a good week.